You know, the mainstream financial media, those suits on CNBC, they spent all of 2025 talking about Bitcoin going up, talking about big tech going down. They missed the only story that truly matters. They missed the 5,000-year-old asset that just absolutely nuked the system. I am talking about silver. While the experts were busy sipping their lattes and reassuring you that everything was fine, silver just pulled off a move so violent, so historically significant, that it exposed the entire rigged game. It broke every major bank that was betting against it. It triggered what we in the trenches call Stage 5 panic. Let me hit you with the cold, hard facts. Silver started the year around $28 an ounce. It was boring. It was sluggish. It was the metal no one wanted. But then something snapped. By late October, the price didn't just crawl higher, it went vertical. It slammed into a high of $59.20 an ounce. Think about that for a minute. That is a 111% return in less than 10 months. Show me one stock, one bond, one supposedly safe investment that did that, besides maybe some questionable crypto coin launched by a teenager. The difference is, this wasn't some flash-in-the-pan meme stock. This was real money, the money of empires, the money of common men. Why did this happen? It happened because the paper mafia, the big banks, the short sellers, the masters of the financial universe, finally ran out of physical metal. They were caught red-handed in the biggest, longest-running con game in history. And when the music stopped, their massive short positions turned into an existential threat. They were betting the price would fall, but instead they watched that price nearly double, bleeding them dry by the hour. They didn't see it coming because they don't deal in reality. They deal in paper promises. And in 2025, the world finally started demanding real silver. This is not a rally. This is a revolt. This is the sound of the dam finally cracking after decades of pressure. And trust me, folks, $59 is just the entry fee. You need to stick with me, because in the next part we are going deep into the belly of the beast, the COMEX, to expose the exact mechanics of how these financial sociopaths got wiped out. And more importantly, what this means for your money. Let us pull back the curtain on the magic trick that Wall Street has been performing for decades. It is called the COMEX, and it is supposed to be the glorious market where silver price discovery happens. But for years, it has been nothing more than a glorified casino where the house printed its own chips. The dirty secret is that the silver market has been fundamentally rigged, manipulated through the relentless, fraudulent sale of paper silver. This paper is futures contracts, promises, IOUs, claims on silver that simply do not exist in the physical world. It is the ultimate financial deception, and the banks were the puppet masters. Here's the unbelievable stat that should make your blood boil. At the beginning of 2025, the total open interest in silver futures on the COMEX represented over 1 billion ounces of silver. That is 1,000 million ounces. A massive, staggering number. Now let's look at reality. The amount of actual physical, ready-to-deliver silver sitting in COMEX warehouses at the same time? Roughly 300 million ounces. See the problem? That is a ratio of approximately 3-to-1 claims versus available metal. But here's the conspiracy theorists' number, the number that actually matters in a liquidity crisis. Some estimates suggest that if you count every derivative, every contract, the ratio of paper claims to physical metal could be as high as 100-to-1. It's an insane, unsustainable leverage. For years, this was fine because the system was built on a lie. The banks knew, and they were counting on the fact that almost no one ever asked for physical delivery. It was all electronic shuffling. They could sell you the same ounce of silver 100 times over, and as long as you only wanted to bet on the price, they made a fortune suppressing that price. But in 2025, the lie hit a brick wall. Starting in the spring, something shifted in the collective consciousness of the smart money. Maybe it was the geopolitical chaos, or maybe the inflation numbers finally became too ridiculous to ignore. Whatever the trigger, physical demand exploded. Industrial users, institutional funds, and large, savvy investors said, "Enough with the paper. We want the metal." This is where the term short squeeze stops being technical jargon and starts being the sound of panic in a banker's office. Imagine you are one of these big banks. You have sold 10,000 contracts betting the price of silver will drop. The price is now rising. You're losing money on paper, but that's manageable. Then the buyers of those contracts start demanding delivery. They don't want cash. They want the actual shiny physical silver. You have two choices. 1. Deliver the metal. Problem: you sold 100 times more metal than you actually possess. 2. Buy back your short position to cover the contract. Problem: every ounce you buy back pushes the spot price higher, which makes your remaining 10,000 short positions lose even more money. You're trapped in a financial feedback loop from hell. This is exactly what happened when silver blew past the $30 mark and kept climbing. Every percentage point increase forced more and more short sellers to cover their bets, creating a frenzy of buying that accelerated the price to $59. They were fighting the market, coordinating desperate smash downs, selling huge blocks of contracts to temporarily knock the price back. But the dip buyers kept coming in, snapping up the cheap metal, rendering the bank's manipulation utterly ineffective. The beautiful, terrible irony is that the system they designed to keep silver cheap became the engine for its massive, violent surge. This is not just a market event, this is poetic justice. It is the sound of the old establishment getting absolutely liquidated by the rules they thought only applied to the little guy. And the collapse of their COMEX control is the single biggest reason why this silver rally is not stopping at $60. Because once the physical demand train leaves the station, there is nothing the paper players can do to stop it. They are riding the rails right into bankruptcy. Now let's anchor this mayhem to history, because this exact scenario, this precise level of systemic stress has happened before, and the lessons from 1980 tell us exactly where we're headed next. If you want to know what happens when the paper market breaks, you do not need a crystal ball. You just need a history book. Because what we are witnessing right now is the ghost of 1980 rising from the grave, except this time, the stakes are exponentially higher. Back in 1980, silver put on a truly spectacular show. It rocketed from single digits all the way up to $50 an ounce. Now, most people attribute that chaos to the Hunt brothers, those eccentric Texas billionaires who tried to corner the market. And yes, they were part of the drama. But the underlying engine of that explosive move was the same force powering today's surge: panic and inflation. In the late 1970s, the United States was drowning in inflation. Jimmy Carter was in the White House, and trust in the dollar was evaporating faster than gasoline in a heat wave. People were desperate for real assets. They wanted tangible wealth that the government could not print into oblivion. Sound familiar? It should. The Hunt brothers simply provided a focus point for the systemic fear. They bought massive amounts of physical silver, forcing the paper price higher until the COMEX, that same corrupt exchange, stepped in and changed the rules of the game mid-play, effectively canceling the trade to save their banking buddies. They restricted trading only to liquidation only to prevent the Hunt brothers from buying more, thereby crashing the price. The historical lesson here is not about the Hunt brothers. The lesson is that the financial establishment will change the rules when their survival is on the line, but they can only delay the inevitable. Now, here's the crucial piece of data you need to fully understand the current $59 price: inflation adjustment. If you take that peak price of $50 from January 1980 and simply adjust it for the official, government-published inflation rate, the Consumer Price Index, that $50 mark is equivalent to over $180 in today's money. Let that sink in. We are currently sitting at $59 an ounce. Adjusted for true inflation, the historical all-time high is nearly $180. That means, even after the massive 111% surge, silver is still trading at a colossal 67% discount to its inflation-adjusted peak from 45 years ago. This is not a market that is overextended. This is a market that is merely correcting 45 years of deliberate, crushing price suppression. It is playing catch-up to the sheer level of monetary debasement and central bank money printing we have endured since the gold standard was finally abandoned. And the reason the catch-up is so violent now is the gold-to-silver ratio. For decades, the ratio, how many ounces of silver it takes to buy 1 ounce of gold, was ridiculously stretched. It hit ratios in the 80s to 1 or even higher. Historically, the ratio averages around 60 to 1. During periods when silver was actually used as money, it was closer to 15 to 1. When silver doubled from $30 to $60, the ratio immediately compressed from the 80s down into the 50s. This compression is the market screaming that silver is fundamentally undervalued compared to gold. The faster that ratio compresses, the more explosively silver has to rise. What the history of 1980 teaches us is not to panic. It teaches us to recognize that when real money assets like silver start moving, their target is not a number on a chart. Their target is the total destruction of the purchasing power of the fiat currency that has suppressed them. The bankers thought they killed the beast in 1980. They only put it to sleep. Now the beast is awake, hungry, and heading straight for $180. But first, it needs to feed on the insatiable industrial demand of the 21st century, which is where things get truly insane. You know what makes silver completely different from gold? Gold is mostly a pet rock. It is a monetary metal that sits in a vault looking pretty. Silver? Silver is the lubricant of the modern world. It is a critical, irreplaceable component in everything the global elite claims to care about. And this is the part of the story the banks genuinely cannot manipulate away: structural industrial demand. The world's governments, the same ones printing trillions and driving up inflation, are simultaneously pushing the green energy transition. They have mandated solar panels, electric vehicles, and massive 5G infrastructure rollouts. They are signing treaties and passing laws that guarantee an explosive, permanent spike in silver consumption. It's the great inconvenient truth of the green movement. It's incredibly silver-intensive. Let's look at the numbers because this is where the logic becomes ironclad. First, solar power. A typical solar photovoltaic panel uses about 20 grams of silver. Sounds small, right? Until you realize that global solar capacity installations hit a staggering 400 gigawatts in 2024 alone, and those rates are accelerating. The solar industry is already consuming roughly 160 million ounces of silver annually. That's nearly 15% of the total global annual silver supply. The kicker is, this demand is not slowing down. It's baked in. If the world is serious about meeting its climate goals, solar capacity must triple or quadruple over the next decade. Where is the silver for that going to come from? Second, electric vehicles, EVs. Forget the gas guzzlers. EVs, the darling of the regulatory environment, use significantly more silver, up to 50 grams per vehicle, compared to maybe 20 grams in a conventional car. They need it for connections, sensors, and crucial circuit boards. In 2024, global EV sales topped 10 million units. If, as analysts predict, that figure doubles to 20 million by 2027, that single sector will add another 70 million ounces to annual demand. The more governments push clean transport, the tighter the silver market gets. Third, 5G and connectivity. Every new 5G base station, every advanced electronic device, every medical application, all require silver for its superior conductivity and antimicrobial properties. This is demand that was marginal a few years ago and is now exponentially growing. When you combine all this industrial demand with investment demand, the retail investor, the institutions, and the central banks all scrambling for protection against inflation, you create a situation of terminal deficit. Listen closely to this terrifying figure. The Silver Institute estimated that the silver market was in a structural supply deficit of over 200 million ounces in 2024. That means the world consumed 200 million ounces more silver than was mined or recycled. And unlike gold, where virtually every ounce ever mined still exists in some form, silver gets consumed. It's used in batteries, in circuit boards, in chemical processes where recovery is often not economical. It's simply lost to the landfill, lost to industrial consumption. We are draining the world's above-ground stockpiles, not just a little bit, but at a frantic, escalating pace. The bankers selling paper promises ignored this reality for years, hoping new mine supply would magically appear, but it won't. New mines take a decade to develop, and the easy deposits are gone. Production has been essentially flat for years. The choice facing the industrial world is brutal. Either the global transition to green energy fails, or the price of silver has to skyrocket to the point where it becomes economically viable to aggressively recycle old products and incentive miners to find difficult, expensive new supply. The industries that need silver, solar panel manufacturers, EV makers, they must have it. They can't just wait. They will pay whatever it takes to secure their supply, pushing the price far beyond the whims of the paper traders. This structural deficit is the fundamental tailwind that ensures silver doesn't just reach $60, it guarantees the path to $100 and beyond, fueled by the very policies designed to save the planet. This is the ultimate irony. The world's desire for a green future is now the single biggest driver of the silver price explosion, and it's unstoppable. Now let's zoom out and see how the biggest, most powerful actor in the game, the Federal Reserve, is pouring gasoline on this already raging fire. While the paper market was collapsing and industrial demand was going ballistic, the third and most powerful force was the Federal Reserve, the people who claimed they had everything under control. They are the ultimate political economists, masters of the gentle lie. And they just hit the panic button, providing the absolute rocket fuel for precious metals. The entire year of 2024 and the early months of 2025 were defined by the Fed holding interest rates hostage, trying to fight the persistent, embarrassing reality of inflation. But by spring, the cracks were not just showing, they were widening into chasms. Regional banks were struggling under the weight of commercial real estate losses. Corporate debt was mounting, the economy was softening, and the risk of a deep, painful recession became undeniable. The Fed blinked. In June 2025, they finally executed the first of what would become a series of rate cuts, starting with a quarter-point reduction, followed by another in September. Here is the central lesson the financial elite does not want you to learn. When interest rates go down, the opportunity cost of holding real assets goes down. Think of it this way. When you could get 5% guaranteed interest in a savings account, holding silver, which pays 0 interest, feels like a bad trade. But when the Fed cuts rates and those savings account returns drop to 3%, then 2%, suddenly that shiny, non-printable, non-debasable metal looks like the genius move of the decade. Lower interest rates deflate the value of fiat currency and signal one thing above all else. The Fed is more afraid of a recession than they are of inflation. They are willing to sacrifice the purchasing power of the dollar to keep the stock market from crashing and to prop up the real estate market. This is pure, unadulterated monetary debasement, and historically, it is rocket fuel for silver and gold. But the macroeconomic pressure does not end there. We are also witnessing the accelerating decline of the dollar's global dominance, the trend known as de-dollarization. Countries like China, Russia, and the BRICS nations are tired of being held hostage by the United States financial system. They are actively settling trade in their own currencies and building alternative payment systems. What do you think backs up these movements away from the dollar? Tangible assets. Central banks globally have been buying gold at record, unprecedented levels for years. But if you dig into the obscure trade data, you can see them increasingly diversifying into silver as well. They are buying the ultimate insurance policy against the US dollar weaponizing its reserve status. When governments and central banks, who are privy to the deepest secrets of global finance, start stockpiling physical assets, it is the ultimate signal that they lack faith in the financial stability of the future. It is a quiet admission that the paper system is failing. This entire convergence, the Fed's fear-driven rate cuts, persistent, sticky inflation, and the geopolitical flight from the dollar, is creating a macroeconomic tailwind so strong it can only be described as a hurricane. It is pushing silver, which has been undervalued for nearly half a century, toward its true historic monetary value. The foundation is set, the history has rhymed, the physical market is starved. The final question is, where does this chaotic self-reinforcing rally stop? Because $59 was a great trade, but the next targets are where the generational wealth is truly made. So we have established the facts. The banks were caught short. The COMEX con is broken. Historical precedence points to over $180, and the green energy revolution is literally consuming the available supply. The question now is not if silver goes higher, but how fast and how high. Let us get conservative first. We're not going to talk about moonshot numbers right away, just the cold, hard, technical targets. After punching through the multi-decade resistance near $30 and the psychological barrier at $50, the next major technical resistance level is clearly defined at $70. This is not a random number. It aligns with multiple Fibonacci extensions and prior resistance points from the last great bull run. Given the macroeconomic tailwinds, the continued Fed rate cuts, the persistent industrial deficits, and the accelerating physical demand, $70 by the first quarter of 2026 is not a hope, it is a mathematical probability. But here is the exciting part, the part that separates the investors from the generational wealth creators, the upside risk. If we see a full-blown financial crisis, a significant banking collapse triggered by commercial real estate debt, or a major geopolitical escalation that completely destroys confidence in the US dollar, the short squeeze mechanics combined with the physical scarcity will take over completely. In that scenario, the price stops being dictated by paper traders and starts being dictated by desperation for real assets. That is the path to $100 an ounce, and it could happen in a terrifyingly short amount of time. This is the asymmetric risk opportunity. Your potential downside, based on current momentum, is a correction back to maybe $50. Your potential upside is multiples of that. You are risking a small loss for the chance at massive, historic gains. But before you click that buy button, heed this final, critical warning. Forget the paper. The price we are discussing, $59 spot, is the paper price. But in the real world, the premium for physical silver, coins, bars, has been exploding. People are paying $3, $4, $5 over the spot price just to get their hands on actual metal. What does that disconnect tell you? It tells you the paper price is a lie. It tells you real demand for real money is stronger than the COMEX allows for. The smart money is not waiting for the paper price to catch up. They are buying physical silver now, accepting the premiums, because they understand that in a stage 5 panic, that physical asset is the only thing that matters. Don't be the fool who watches the greatest wealth transfer of the century happen from the sidelines. The banks missed the 111% move. They are bleeding. They are trapped. But you have the data, you have the logic, and you have the history. The time to position yourself in the ultimate crisis hedge is now, before the $70 barrier breaks and the road to $100 opens wide. The question is, are you going to be holding paper when the music stops, or are you going to be holding the real thing? Please like, share, subscribe to the channel.